By mid-July 2026, the artificial intelligence industry appeared to be hitting a new peak. Google was launching its massive Gemini 3.5 Pro model, a system capable of advanced reasoning across 2 million tokens. Yet beneath that surface, the tech market was suddenly shutting down, erasing billions in value in a matter of days. This chart shows the Philadelphia Semiconductor Index. After peaking in late June, it plunged over 20% in less than a month, meaning the builders of the world's most advanced chips officially entered a bear market. The software sector fared no better. On July 14th, IBM issued an earnings pre-announcement, revealing a massive revenue miss. The market responded by cutting IBM's stock price by 25% in a single day. To find a worse day for the company, you have to look back to the trading floor of 1968. This wasn't a standard dip, it was a historic collapse of confidence. It presents a strange contradiction. Why are the companies building the physical hardware and the giants writing the software failing at the same time the technology is supposedly getting better? The tech sector is currently cannibalizing its own revenue, caught in a chain reaction started by a product launch half a world away. The disruption began at the World AI Conference in Shanghai. A startup named Moonshot unexpectedly revealed Kimi K3. This is a 2.8 trillion parameter model. In benchmark testing, it matches the performance of the most expensive American systems, including OpenAI's GPT 5.6 and Anthropic's Fable 5. But Moonshot released Kimi K3 as an open weight model. This means the underlying intelligence is freely accessible to the public, instantly turning the most advanced AI in the world into a free commodity. This shift is why investors panicked. The massive valuation of the U.S. hardware sector relies on a proprietary monopoly over frontier AI. If the world's best models are now open-source commodities that run on any system, the specialized moats built by companies like NVIDIA and Google lose their exclusive profit power. The Kimi K3 shock revealed that the tech sector's defensive moat was thinner than investors realized, placing trillions in hardware infrastructure at immediate risk. While the hardware sector reeled from the foreign threat, IBM CEO Arvind Krishna explained why his software business missed revenue targets at home. He pointed to capital expenditure, or CAPEX. His warning to investors was clear: corporate clients are not finding new money to pay for AI. This chart illustrates budget cannibalization. To afford new AI chips and servers, companies are defunding their existing enterprise software and mainframes. This zero-sum reallocation is exactly what starved IBM's revenue streams. Clients shifted budgets to hardware, leaving the software business with a massive deficit. The AI supercycle is acting as a parasitic force, draining the legacy tech economy to sustain its own expansion. The tech sector is now caught in a squeeze. The VanEck Semiconductor ETF dropped 9% in a single week, as the market absorbed the pressure from both the hardware and software sides. American companies are bleeding their core businesses to buy hardware that might soon be obsolete. They are spending record amounts on infrastructure, just as foreign open-weight models threaten to make those expensive servers a low-margin commodity. These converging crises hit the structural limit of Silicon Valley's build it and they will come approach to AI. AI projects can no longer survive on cannibalized budgets and future promises. To justify these costs, these tools must begin generating immediate, measurable revenue. Unless AI tools start producing real-world returns now, the July 2026 bear market is more than a correction. It is the blueprint for a broader collapse of the AI investment thesis.